You have a book. It's called Invest Like the Best. And this book has a number of very interesting synopses. I'm not sure what the plural is there, but a bunch of interesting ideas. And a lot of these caught my interest when I was reading through it. But the first one I wanted to ask you about, maybe even challenge you about a bit, is the kind of subtitle here. It says, The Low Risk Road to High Returns. Now, you're not just an author, but you've worked in finance for a long, long time, 30 or 40 years, if I'm not mistaken. Now, is there really such a thing as high returns with low risk?
Absolutely.
Okay.
Absolutely. So I think there's an enormous confusion about the issue of risk. We're talking about long-term returns because in the short term, anything can happen.
Sure.
But if you want to reliably, with a very high probability, make exceptional returns over decades, you have to think about things differently.
Okay.
And I think one of the highlights of the book is to compare, say, on the one hand, John Meriwether of long-term capital management, who had a fantastic return for 3 years and then wiped out, and compare him with Jim Simons and Stan Druckenmiller on the other hand.
Right.
Who for 30 years, Stan Druckenmiller, 30 years compounded 30%. And how many down years did he have in 30 years? 0. So there is, what you need to do if you're hiring a manager is you need to know, am I with a Stan Druckenmiller or a John Meriwether?
Right.
Because if you're just looking at return and seeing a lot of risk, that may not be what you want.
Okay.
So you need something else.
What is that something else? How do people get around this? Other than having proprietary information, but yeah.
Well, there are two major parts. If you want to talk about the math of risk and return, that's all about part 2 of the book. It's all about the math of risk and return. And that spells out what the best investors do. Right. And really it's so simple and so clear when you see it that, it's, why didn't anyone tell me this? It's very simple. They look at risk absolutely first. And what they want to do is find high return relative for the risk and then manage that risk really well. That's essentially what they do. Okay. And the whole chapter is a comparison between what the best investors do, which is that, and you could write it out mathematically. It's very simple, and what most financial advisors do. Most financial advisors have bought into the idea that, okay, the more risk we can take, the higher the return's going to be. So how much risk can you take? And then we'll allocate to risk and get that high return. It's a very simple line of argumentation. It's just wrong.